How to revive the housing market. The government has tried any number of ways, from home buyer credits to mortgage modifications to, once again, lowering lending standards. They all haven't worked, and neither is the latest effort, the Fed's bond buying program, QE2. Instead of going down, mortgage rates are going up. With us this morning to discuss the impact and the options, Edward Pinto. He was chief credit officer at Fannie Mae back in the 1980s, before that company developed its taste for subprime loans. Ed is currently a resident fellow at the American Enterprise Institute. He's with us on the telephone. Ed, what is it going to mean for housing that mortgage rates, the average 30-year mortgage rate has jumped to more than 4.7% in the past 3 weeks alone from 4.2%?
Good morning, Eric. Pleasure to be on the show. I don't want to indicate that interest rates are irrelevant. However, rates have bounced around between 4.25% and 5.25% for the last couple of years, and it's not interest rates that are the problem. The housing market is suffering from two related but independent problems. Number one is there's just too much debt. It's too over-leveraged. The debt needs to be reduced. The normal way you do that is you foreclose, and we have been postponing the foreclosures for a couple of years now, and it's dragging out the bottoming of this market, and it's creating additional problems. Secondly, you need more jobs. Jobs is what creates demand for the excess units, and we haven't been getting strong enough job growth. And those are the two issues that have to be addressed. Whether interest rates are 4.25% or 4.75% is not the issue, in my opinion.
So you think it's much more important for the housing market to clear, to get all the what would be excess inventory into the hands, or at least so that we know what the inventory is and so that prices can adjust accordingly?
Absolutely. That's exactly what needs to happen.
Now, what's going to be the catalyst for that then? If anything, what we see right now suggests that the foreclosure process is only going to drag on longer because of all the court disputes over the so-called robo-signers.
Well, I think the reaction of the administration to the latest robo-signer issues has been relatively measured, which is I view as a positive sign. They haven't really jumped on the bandwagon and started pushing solutions that are going to make the problem worse. They've said, look, you need to find out if there are cases that have occurred where some recompense needs to be had. You need to find out if there are policies that need to be fixed. But at the end, you need to get the foreclosures done. The regulators have said this. Fannie and Freddie have said this. You need to go forward with foreclosures because the market can't clear without it. And it's been a couple of years, and it's creating problems. The issue right now is there are too many foreclosures in given markets that haven't cleared. The properties haven't been put on the market. They need to be put on the market. It's going to have a short-term impact, but once that clears, then prices find a bottom, and then people know they can come back into the market more safely. Right now, I'm hearing from appraisers that they're very concerned because they're being asked to appraise properties that have a sales price of, let's say, $150,000. But in their opinion, they think the prices are going to be going down in 6 months. And a lot of these individuals are getting loans from FHA with very, very small down payments, and they're wondering what's going to happen to these borrowers in 6 months when they find out they're underwater.
Well, we'll have to wait 6 months and find out, I suppose. Ed, thank you very much for your insights. Ed Pinto, he's the former chief credit officer at Fannie Mae from the 1980s, I should add. He's currently a resident fellow at the American Enterprise Institute.